Ever wondered what makes a stock a good buy or a poor one? What is the secret behind the success of the most successful investors in the world? This secret is hidden in the art of fundamental analysis. It's a tool that can empower you to make informed investment decisions. Today, we will unravel the intricate web of terms related to fundamental analysis, explaining each one with examples. So, are you ready to unravel the mystery of stock trading? Let's dive deep into the world of fundamental analysis. First off, let's talk about earnings per share, or EPS. This simple yet powerful metric represents the portion of a company's profit allocated to each outstanding share of common stock. It's calculated by taking the company's net income, subtracting any dividends on preferred stock, and then dividing the result by the number of outstanding shares. Here's a quick example. Let's say Company A has a net income of $1 million, no preferred dividends, and 1 million outstanding shares. The EPS would then be $1. This means for every share of Company A you own, the company has earned $1 of profit. EPS is a significant indicator for investors as it provides insight into a company's profitability. It can also affect the price of a stock, as shares of companies with higher EPS values are often more attractive to investors. So, a high EPS can be a sign of a profitable company, but remember, it's just one piece of the puzzle. Moving on, let's delve into the price-to-earnings ratio, often referred to as the PE ratio. This is a valuation ratio of a company's current share price compared to its per-share earnings. It's calculated by dividing the market value per share by the earnings per share. Consider this example. If a company's stock is trading at $50 per share and its earnings per share for the last 12 months is $5, then the PE ratio would be 10. This essentially means that investors are willing to pay 10 times the earnings for that stock. Now, what does this tell us? Well, a high PE ratio could suggest that the stock is overvalued or that investors are expecting high growth rates in the future. Conversely, a lower PE ratio could mean the stock is undervalued, or perhaps the company is not expected to grow as much. In essence, a lower PE ratio could mean a stock is undervalued. But as always, further analysis is needed. Next up, we have return on equity, or ROE, another crucial term in fundamental analysis. ROE is essentially a measure that provides insight into how effectively a company is using its shareholders' equity to generate profits. Now, how do we calculate it? We simply divide the company's net income by its shareholders' equity. The result is expressed as a percentage. For example, if a company has a net income of $1 million and shareholders' equity of $5 million, the ROE would be 20%. So what does this mean? The higher the ROE, the more efficiently a company is using its equity to generate profits. It's a great way to evaluate a company's profitability. But remember, it's not just about the number, it's about understanding the context. So, a higher ROE might indicate a more profitable company, but it's important to compare it with industry peers. Now, let's consider the debt-to-equity ratio, also known as the DE ratio. This metric essentially measures the financial leverage of a company. It's calculated by dividing the total liabilities or debt of a company by its shareholders' equity. Essentially, it shows the proportion of a company's funding that comes from debt versus equity. Let's take an example to illustrate this. Suppose we have a company, let's call it Company X. Company X has total liabilities of $1 million and the shareholders' equity is $2 million. So the DE ratio for Company X would be 1 million divided by 2 million, resulting in a ratio of 0.5. This ratio is significant because it gives us an idea of the company's ability to cover its liabilities with its equity. It's a measure of financial risk. Therefore, a lower DE ratio often suggests a less risky investment, but it's not a standalone indicator. Lastly, let's examine the dividend yield. This is a financial ratio that shows how much a company returns to its shareholders in the form of dividends. It's calculated by dividing the annual dividend payment by the market price per share. So, if a company has a share price of $50 and pays an annual dividend of $5, the dividend yield would be 10%. This means for each share you own, you're getting a return of 10% on your investment, just from dividends. Now, let's imagine we're comparing two stocks. If stock A has a dividend yield of 6% and stock B has a yield of 4%, you might think stock A is the better investment. But remember, dividends are just one part of the picture. Other factors like the company's growth potential and financial health are equally important. So, a higher dividend yield could mean a more rewarding stock, but it's not the only factor to consider. Well, we've covered a lot of ground today, haven't we? We've journeyed through the fascinating world of fundamental analysis, exploring its various aspects and how they can aid you in making informed investment decisions. We started our journey by understanding earnings per share, or EPS. Remember, this is a measure of a company's profitability, calculated by dividing the company's profit by the number of outstanding shares. It's a powerful tool to assess the financial health of a company, but it's not the only one. Next, we decoded the price-to-earnings ratio, or the PE ratio, which compares a company's market value per share with its earnings per share. It's a simple yet effective way to evaluate whether a stock is over or undervalued, helping you to make smarter investment choices. Our journey continued with the exploration of return on equity, or ROE. This measures a company's profitability by revealing how much profit a company generates with the money shareholders have invested. It's a key indicator of financial efficiency and a must-have tool in your investment arsenal. Next, we unraveled the debt-to-equity ratio, or DE ratio. This tool compares a company's total debt to its shareholders' equity, providing a snapshot of the company's financial leverage. It's an invaluable tool that can help you assess the risk level of your potential investment. Finally, we deciphered the dividend yield. This is the financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It's a great tool for income-focused investors, as it can provide a steady stream of income in addition to any potential capital gains. All these tools, when used together, can paint a comprehensive picture of a company's financial health, its profitability, and the potential risks and rewards of investing in its stock. They are the cornerstones of fundamental analysis and can significantly improve your ability to make wise and informed investment decisions. Remember, fundamental analysis is about understanding the company behind the stock. So, equip yourself with these tools and embark on your investment journey with confidence. Until next time, keep learning, keep investing.